Buying a home nowadays feels like you're going to an auction house. You got the paddle in one hand, just raising it, trying to get to the highest price so that you can win the house. But in the other hand, you have your bank account and the pre-approval letter, and you are hoping beyond hope that you can afford what you just bid and won. Right? Is that what it feels like? I'm sure it does nowadays. It doesn't matter if you're a first-time home buyer and you're just trying to figure it out, or if you've bought homes before. The costs of home are so expensive nowadays. They just are. There's lots of reasons that we can get into about why they are and what's going on with the markets and all that stuff. That's not this video. This video is to make sure that since home prices are so expensive, that we have a good debate of whether or not buying a home is right for you or not, and how you make sure that the home purchase you make doesn't derail the rest of your planning. It's got to be built on the same financial platform that all of your other stuff is. And there's a lot of different things. I've gone through the home buying process 3 times now, and there's a lot of things that are said to you that aren't necessarily, they fit with regulations, but they don't necessarily do you any good down the line. And it's because it's a short-term transaction for those people. And I'm not saying anything bad about them. I'm not saying they're evil, horrible people or whatever, but they are not in the realm of looking at the big picture. I stay with clients for 10, 15, 20, 30 years of their financial journey, maybe more. And so you do want to make sure that you have a good financial foundation, and buying a home for a lot of people is part of that, and you want to do it in the right way that works with everything else. So if that sounds good to you, stick around, because that's what we're going to talk about. And just a moment just to welcome anybody new. Hi, I'm Lisa. I've been a financial advisor for over 14 years, and I help people get to financial freedom as quickly as possible. If you're back for another video, welcome back. We're happy to have you. Okay, so there is this kind of push and pull on whether or not people should be buying a home. And I think part of that comes from, there are some good arguments. I mean, there's some money influencer people out there that have good arguments of why people shouldn't buy a home. And we'll kind of get into some of those reasons in a second. However, I would say for the vast majority of people that I have met, and I've talked to hundreds and hundreds of people throughout these many years I've been doing this, that essentially it is it's an important part of your planning. And I think a lot of people are saying you don't need to buy a home because they feel defeated, and it feels better to just reject buying a home than feel rejected by the home market. And I totally understand that. But there are some really good things you can work towards so that you are able to purchase the home that you want and that will fit into your planning and will keep you on that path towards financial freedom, because I know that that's what most people want, is to get to financial freedom as fast as possible. That's why I help people with that. So let's get into kind of the nitty-gritty of some of the things that are the basics of buying a home that you might roll your eyes and go, I know this, I've bought a home before. Maybe this is stuff you've read in a book or something. I'm going to give you the financial advisor's point of view on it, at least my financial advisor's point of view on it, let's put it that way. So one is the down payment and closing costs. Just as a rough estimate, down payment, I would say typically you want 20%. We'll get into that in a second of why. Closing costs can run anywhere between 2 to 5%. So I would kind of lean towards the 5% part of it. So just to give you an example, if you are buying a $500,000 home, it's $100,000 down, maybe $15,000 for closing cost. That's what you would need to save. Now, I'm going to put a little caveat on this, though. You do also want to put away some money for fixing the home up. It doesn't matter if you're buying a brand new home. Okay, I've done that. There's still money that you have to spend on stuff. There's still little things that need to get fixed, or there's always stuff to spend money on. The first couple months of buying a home, whether it's brand new, whether it's old, it always feels like you're just bleeding money. I mean, it just is, it's not a good feeling. you don't sleep well because you're like fixing everything up, and you're just like shedding money out. It is a very uncomfortable time financially. It is. Now, in the long run, I think it's worth it, but make sure you have some extra money. So in that case, for $500,000, I might tell somebody to have $30,000 saved extra for things that need to go into the house. Maybe you need to do the backyard. Maybe the roof is a little worse than your inspection showed you. There's different things that you've got to do. And having that $30,000, even if you don't use it, let's say you only use $5,000 of it, that can go to your house fund, which I think is important to have as just a general rule anyhow. And we'll get into that. But a lot of people say 20% down. Why would you say 20% down? 20% down is the number you have to get to in order to avoid PMI, which is insurance essentially. It's the mortgage insurance. And I would say that spending money on an insurance that you don't need to spend money on is a bad way of starting off that relationship with your home. It just is. I know that that sounds mean. It's not mean. It's actually nice, because I don't want you throwing money that you work really hard to put, to have away on insurance, when really maybe you could have taken, 6 more months and saved and gotten there. It's thinking long-term versus short-term. And I am a long-term thinker versus a short-term thinker, because I have to. I'm with clients for 30 years of their lives, sometimes maybe more. And so you do want to make sure that you are thinking long-term, because your home is an asset. It is one of the building blocks when it comes to your financial plan, and you want to make sure that you understand it. So I would really hesitate to tell anybody to go in with less than 20% and pay the PMI. I just don't think it's a good idea. We had to do it for our first house, and it's hard and it's expensive. It's so much more expensive than people tell you it's going to be. It's just one thing I would just avoid doing. It's not fun. We're very lucky we got out of it pretty quickly, but it's just not fun to do. All right, so when you're looking at monthly affordability, here's the thing that I think gets screwed up the most. A, the down payment not being enough, but B, this is the other thing that really can screw people up when they're incorporating a home into their plan or changing homes or etc. You don't look at the full cost of owning a home. And this is the argument that people have of why people shouldn't own homes. And I can see this. You look at the monthly payment, but then you don't look at the insurance. You don't look at the property tax. You don't look at HOA. Maybe you do, but then you don't look at maintenance and utilities, right? And I, as a seller, would have had no problem if somebody had come through their agent and said, what's your average monthly utility bill look like? That would have been fine with me. Actually, that would have made me feel better if they had asked that before they put a bid on our house, because it shows that they were thinking it through, that they're looking at affordability. And the problem that happens is people just kind of keep bidding on homes, not really knowing if they're affordable, and then they get under contract and then they pull out, and then they pull out, and they do that. It's just hard we've had that happen to us. It's just hard when people continue to keep pulling out because they didn't actually do the math before. And please do the math. As somebody who sold a couple of times, we had like 6 people pull out because of that kind of stuff once. It was crazy. Anyhow, the thing that you need to think about is when you are getting all these quotes on stuff, they'll say, oh, below 28 to 30% of your gross income can go to your housing costs. That's what will qualify you for it. I don't like that. I think that is a bad way of doing it. I really think you need to look at your net income. And this is not for mortgage people. You don't have the mortgage people do this. You do it. This is your life. This is your loan. You need to have ownership of this, okay? And so you look at your paychecks, and most of us get 2 paychecks a month, right? Maybe 3 on an occasion, but let's just take a look at the 2, right? So 2 paychecks a month, 1 paycheck, can you live off of outside of housing? Does that sustain your lifestyle so that you don't create credit card debt? Can you live off of that, including your savings, right? And then the other paycheck that you take home can go to the home, mortgage, all that stuff. Mortgage, property tax, HOA, all that stuff should pay for it with one paycheck. If you look at the first paycheck and it doesn't cover your life expenses outside of housing, then you really need to think about that, right? Then you gotta say, well, 3/4 of this paycheck can go to home, but then I need 1/4 of that to go into this paycheck. That's the way you look at it. This gross income stuff drives me crazy because we pay for things through, not only is it taxes and stuff, but you're paying for healthcare, you're paying for your 401k. They have student loan programs now through your benefits. Sometimes you have dog insurance that you can pay through. I mean, there's all these different benefits that come out. So gross means nothing to me. So it drives me crazy when people say, oh, the rule of thumb is blah, blah, blah from gross income. No, it's net. Because that's how you're paying it, is from net. So obviously that gets me upset. I don't like it when people talk about gross income because that doesn't mean anything. I need to know what you bring home every month. That's what I need to know. And it goes with financial planning too. You need to know what you bring home every month. The number at the top doesn't mean much. It's the number at the bottom that means something when it comes to your financial planning. Now, of course, the argument can be made, well, some of those things are going to your financial planning, like if you're putting in your 401k and stuff. Of course, we would consider that. But really knowing your net numbers and how your cash flow works that way is really important. And this is a time, now, if you've watched some of my other videos, you know, I'm not a big budget person. I don't think doing budgets makes any difference for people because they don't follow them, you know, and budgets are just kind of like what they were at that moment. And it's hard to follow them, and there's so much work to put together, and then you don't follow it, and it just feels like a waste. I don't think, and it feels defeating in some respects. So I don't like budgets, but this is the time you do a budget. This is the time you really take a look at your expenses more than just looking at your credit card statements like I usually tell you to do. And this is the time you actually do a budget so you know what your expenses are. It's just really important. Okay, emergency fund. Now, we talked about it a little bit, but your emergency fund is your emergency fund. It's 3 to 6 months. That doesn't get touched. That should never go to your down payment. Never, ever, ever should that go to your down payment. Emergency fund is there for emergency. And like I said, adding on to some money saved for those external costs that are going to happen when you buy a home, which are probably inevitable for most people, that should be in addition to your emergency fund. And a lot of people, I actually recommend, once you're settled in the home and everything else, it is expensive to rent a home. You know, this goes out or that goes out or this, you know, something happens, we have this happen, whatever. It's good to have a house fund. And I would say house fund is probably, you know, 3 months. I know that that seems excessive, but honestly, if a big thing goes out in your house, you don't want to, I mean, yes, you could pull you from your emergency fund. That's what it's there for. But you could pull from your emergency fund if something goes out. But let's say you want to do an upgrade. That's not an emergency. You don't want to be pulling that money up for some upgrade and then something happens and you don't have your emergency fund. So I really think you should have a house fund, and it should be about the same as your emergency fund. Now, that house fund can be in like a high yield savings account or something like that. It doesn't have to be sitting in your bank account. Same with your emergency fund, technically. But make sure you run the numbers and really look at stuff. The other number that gets thrown around a lot is debt to income ratio. And they say under 36% is typical. Again, that doesn't mean much to me. I would say look at your cash flow. Look at how things are going in and out of your house. Take a look at that double, you know, paycheck month and really take a look at what you're spending your money on rather than debt to income ratio. Now, for their purposes, they need it to be under certain percentages, right? Meaning mortgage people have to have it fit within a certain percentage to get you the loan. Okay, that's fine. That's not necessarily your number. So they have their set of numbers that they need to utilize, which is totally fine. Do not use those as your numbers, is my point. You have to have your own set of numbers. You don't have to talk to them about that or anything. This is your plan. This is your home. They go off and they do another loan someplace else after they're done with you. I mean, that sounds horrible. Not done with you. After they're done with your loan, they go off and do something else. This is your loan, right? So you need to know how this all works. Here's some other just really short considerations to think about. Stability versus flexibility. One of the arguments that have been made about not buying a house is that people like to move from place to place and change locations and all that stuff. If that's you, I agree. Don't buy a house, because you really should be in your home for 5 to 7 years to really feel the good benefits from buying a home as an asset. And if you are not planning on being there for 5 to 7 years, it might not work out for you. Now, we were in a home for, I think, 4 years. I think it was 4 years. And it happened to work out for us. But we were lucky because I was planning on us being there for 5 to 7 years at least. So it can be lucky, but I really think that if you were not planning on being in the home for a significant portion of time, I kind of agree with those people who say don't buy a home, because it can end up costing you more than actually benefiting you in the long run if you don't do that. The other thing is that idea of, well, if I buy a home, then I wouldn't have money to put into the stock market. That's not a good way to look at it, okay? Maybe you need to just buy less of a home. That could be the answer, right? Because you should have a balanced plan. It should have some real estate in it and some investments and savings in it. There should be these different buckets. They shouldn't do the same thing. It's not all investing or all real estate. That's when we get lopsided, and when one market starts to go down, it really can get thrown off quite a bit for your planning. So you want to make sure you understand where your different buckets are and have them be as even as possible. Your home is always going to be a bigger asset, most likely, than your investments until you get to a certain point or certain savings. But a lot of people, their home is their biggest asset. So it's balanced in a way, but you understand what I'm saying. Anyhow, also think beyond the now. So take a look at the history of where you're buying and make sure that you understand where the prices have been for a while, how they jumped, how they went down. Know that area, and also know that information about the areas around you, because you don't want to be buying in a location that seems so wonderful, but 2 streets down, it's not a good location. That does not make it so that your house necessarily is desirable in the future if you do want to sell. So you do want to take a look at the whole area, and you want real world examples of how things have been moving. So really take a look at the entire area. You do the homework. Yes, your real estate agent can do some of it, but you do the homework because you know the information, you will have the questions. You've got to be in the driver's seat. A lot of times I've noticed that people, when they are buying a home, sit back and wait for real estate agents and mortgage people to tell them what they should do. It's your home. Again, they're going to move on to the next set of clients. And yes, they would love to work with you again in the future, but you are the one that is going to be with this home. So you want to make sure you're in the driver's seat. And honestly, for many of the mortgage and the real estate people that I have talked to, they would prefer it to be that way. They want you to be they want to guide you and tell you, here's some rules, here's some different things that we need to hit and all this stuff. But they want you to be pushing the train forward. So here's a couple of tips just to leave you at the end. Get pre-approved, but know your real budget. Consider buying less than what you're approved for. Nobody wants to be house poor, meaning having too much house and not enough money, right? You want to explore all different options when it comes to mortgages. Be wary of adjustable rates, etc. I know that those are kind of out there now a lot because of the interest rates being higher. Be careful of those kind of things. Really understand how that works. And again, be a long-term thinker. Think in 8 years, in 7 years, when I get this balloon payment, or what, however it's set up, how am I going to react to that? How is that going to work? What's my out clause? What's my, you really have to think about all those. So if you're going to go with kind of a specialized mortgage, really be wary of what's going on and ask tons of questions, do lots of research, and make sure you're prepared for that. Don't be afraid to ask and negotiate for things, closing costs, seller credits, interest rates, interest rate buy downs, all those things it doesn't hurt to ask. You don't need to be a jerk about it, but it doesn't hurt to ask and try to negotiate some of those things. If you can get the price down, that's great. Now, you don't want to fatigue people. You don't want to do it for everything because people don't want to work with you then. But you do want to have some negotiation, and just, you can kind of lightly say, hey, is it possible to get that down a little bit? Or is there a way to get this a little bit lower cost or something like that? It's crazy, but anyhow, it's buying a house is a crazy process. It just is. But it's worth it in the long run, I think, for most people. I really do. So remember, today's message is to prepare, and don't panic. Don't be that person like raising the paddle 15 times to just try to get the house and then figure it out. Really have your homework done before you start raising the paddle, and know where your limits are, and you run the show. Okay? So your home shouldn't turn into a financial nightmare, which it has for many people. It did for a lot of people in 2008 too. And some of that was not anybody's fault, none of their fault. It just, unfortunately, things happen. And you want to have the stability in buying a home as you can. You want to run the numbers. You want to prepare for your surprises. You want to make sure the purchase supports, not derails your overall journey to financial freedom. So with that, hopefully you found this helpful. You weren't distracted by my looking at my notes, because I'll go on forever on this topic if you let me. But how are you feeling? Are you thinking about buying in this market? Are you one of the ones that are waiting till the interest rates go down? How is everything going for you? Feel free to reach out and let's have dialogue about it. So until next time, stay strong out there, be kind to one another, and we will see you on the next video. Bye-bye.